Did you know the stock market can affect everything from the price of your morning coffee to international relations? Today, we're uncovering the hidden impact of the stock market on our daily lives and the global economy. The stock market isn't just a playground for Wall Street brokers or a ticker tape running along the bottom of your news screen. It's a powerful force that influences the economy, politics, and even societal trends across the globe. But how does it work, and why should you care? Today, we're breaking it all down. The foundation of the stock market. Let's start with the basics. The stock market is a collection of markets where stocks, pieces of ownership in businesses, are bought and sold. This might seem straightforward, but the ripple effects are far-reaching. When companies perform well, their stock prices go up, encouraging more investment. Conversely, if a company falters, its stock price drops, potentially causing a panic. The origins of the stock market can be traced back to the 17th century with the Dutch East India Company, which issued the world's first shares and became the first publicly traded company. This innovation allowed ordinary people to invest in the lucrative spice trade, revolutionizing finance and setting the stage for modern stock markets. Interestingly, the Amsterdam Stock Exchange, established in 1602, is often considered the world's first official stock exchange. This early system laid the groundwork for the intricate global markets we have today. Historically, the stock market has been a barometer of economic health. The New York Stock Exchange, NYSE, established in 1792, and the NASDAQ, founded in 1971, are the two largest stock exchanges in the world. They host thousands of companies whose stock prices reflect their business performance and broader economic conditions. Global impact. Stock markets around the world are interconnected. For instance, when the US stock market sneezes, global markets catch a cold. This was evident during the 2008 financial crisis, which started with the collapse of Lehman Brothers in the US, but quickly spread to Europe, Asia, and beyond. One of the most fascinating aspects of the global stock market is the phenomenon known as the butterfly effect. This concept, derived from chaos theory, suggests that small changes in one part of the world can trigger significant impacts elsewhere. For example, a minor policy change by the Federal Reserve in the United States can influence interest rates and investment flows in emerging markets like Brazil or India. This interconnectedness shows how deeply entwined our global economy is, where even local events can have far-reaching consequences. A study by the International Monetary Fund, IMF, found that stock market shocks in major economies like the US and China significantly affect other countries. When US markets fall, there's often a domino effect due to the interconnectedness of financial systems and global trade. Impact on the economy. The stock market can impact various economic aspects, from corporate financing to consumer confidence. When stock prices are high, companies can raise capital more easily by issuing new shares, which they can invest in growth and expansion. This can lead to job creation, higher wages, and economic growth. Conversely, a declining stock market can erode consumer confidence. People see their investments shrink, which can lead to reduced spending. This phenomenon, often referred to as the wealth effect, shows how stock market performance can influence personal financial decisions and broader economic trends. A lesser-known but intriguing impact of the stock market on the economy is its role in fostering innovation. When companies go public, they gain access to substantial capital that can be used for research and development. This influx of funds has historically driven technological advancements and breakthroughs. For instance, the rise of tech giants like Google, which went public in 2004, has led to significant investments in AI, cloud computing, and other cutting-edge technologies. These innovations not only boost the economy, but also transform industries and improve our quality of life. Political and social impact. Stock markets also have significant political and social implications. Governments closely monitor stock market performance as it can affect political stability. For instance, the 2008 financial crisis led to political upheavals and changes in government in several countries, including Greece and Iceland. Moreover, stock markets influence public policy. In response to market downturns, central banks might lower interest rates or implement quantitative easing to stimulate the economy. These decisions can have far-reaching effects on everything from inflation rates to unemployment. One incredible example of the stock market's influence on politics is the tequila crisis in Mexico during the mid-1990s. This financial crisis, triggered by a sudden devaluation of the peso, caused the Mexican stock market to plummet. The subsequent economic turmoil led to massive protests and political instability, eventually forcing the government to seek a $50 billion bailout from the United States and the International Monetary Fund. This event underscored the power of financial markets to influence political regimes and foster international cooperation. Tech revolution and stock markets. The rise of technology has revolutionized stock markets. High-frequency trading, where computers execute thousands of trades in a second, has changed the landscape of stock trading. While this can increase market efficiency, it also poses risks. For instance, the flash crash of 2010 saw the Dow Jones Industrial Average plunge nearly 1,000 points in minutes due to automated trading. Additionally, technology companies have become some of the most valuable entities in the stock market. Companies like Apple, Microsoft, and Amazon have market capitalizations in the trillions, and their performance can significantly influence the overall market. Did you know that quantum computing could revolutionize stock trading in ways we've never imagined? Quantum computers, leveraging the principles of quantum mechanics, can process complex calculations at unprecedented speeds. This technology has the potential to optimize trading algorithms far beyond current capabilities, potentially predicting market movements with greater accuracy and transforming how we understand financial modeling. Companies like IBM and Google are investing heavily in quantum computing, signaling a new era for stock markets. Social media and stock market. In recent years, social media has started to play a unique role in the stock market. Platforms like Twitter and Reddit can drive stock prices. A notable example is the GameStop saga in early 2021, where retail investors, coordinated through Reddit, drove up the stock price dramatically, causing significant losses for hedge funds that had shorted the stock. This event highlighted how social media can democratize market influence, allowing retail investors to challenge institutional players. However, it also raised concerns about market manipulation and volatility. One of the most astonishing impacts of social media on stock markets was the surge in meme stocks. Beyond GameStop, companies like AMC Theaters and BlackBerry also saw their stock prices skyrocket due to social media hype. This phenomenon wasn't just about retail investors. It highlighted a cultural shift where investing became a form of social and political expression. The collective power of online communities challenged traditional financial power structures, illustrating the democratization of market influence in the digital age. Stock market and personal finance. On a personal level, understanding the stock market can be crucial for financial planning. Investments in the stock market can provide substantial returns over the long term. According to a study by Credit Suisse, global equities have returned an average of 5.2% per year after inflation from 1900 to 2018, outperforming bonds and cash. However, investing in the stock market also comes with risks. Diversification is key to managing these risks. By spreading investments across various sectors and geographies, investors can mitigate the impact of a downturn in any single market. Future of stock markets. Looking ahead, the stock market will continue to evolve. Emerging markets, such as those in Africa and Southeast Asia, are becoming more significant players. These markets offer growth opportunities, but also come with higher risks due to political and economic instability. Moreover, sustainability is becoming a crucial factor. Environmental, social, and governance (ESG) investing is on the rise, with investors increasingly considering a company's impact on society and the environment alongside financial returns. According to the Global Sustainable Investment Alliance, sustainable investing assets reached $35.3 trillion in 2020, a 15% increase from 2018. Companies like Betterment and Wealthfront have made investing accessible to millions, offering low-cost, personalized financial advice. This innovation is revolutionizing how people engage with the stock market, enabling even novice investors to benefit from sophisticated investment strategies without needing a financial advisor. That's all for today's video. If you found this video insightful, Don't forget to hit the like button and subscribe to our channel for more in-depth explorations of the world's most fascinating topics. Stay tuned for our next video, where we'll uncover more hidden influences shaping our world.